Hello, everyone. This is Thomas Wright Russell. Hopefully you have already watched the PY 2021 Operations Overview training. If so, then you already know the drill with how the trainings are going to go this year. So this is going to be the income training. Spoiler alert here, we really didn't change our policies with regards to income at all for 2021 based on when compared rather to 2020. So this is all going to be a review. In fact, I'm literally just using last year's presentation here. Biggest difference is, unfortunately, you have to just listen to me for the entire time rather than getting Renee to break things up. But honestly, we've been very happy with what we've seen in the monitoring so far this year with income calculations for last year. It seems like some of the things that we did to help simplify things helped everyone, and I think just the income calculation across the board has become a lot more consistent among the LSPs. So you guys are doing a really great job with this. Hopefully the fact that we're not changing anything means that it's just going to continue to improve. And this is going to be a really high level training here. Again, more review than training. I spoke in the last video about how weird it is to record this kind of training and not be able to get any feedback from anyone in real time, or to just to see facial expressions, see what people are having questions on. And I think with income calculation training, that becomes even more of a barrier. So I'm just going to go over this real quick. This should be a lot shorter than the overview training was. I'm just going to go through hit the main points of last year's presentation. You guys all have the manual, and any questions that get elevated to us, if we see the same questions coming through, we'll certainly put out a new video to address those. But for now, I am just going to jump right into it. Because again, I know that it can be easy to sort of zone out during these trainings, and I want to keep these pretty fast-paced and snappy for you. So with that said, I am going to share my second screen and start going through the presentation. Okay. So what we're going to be going over in this is calculating crisis, income calculation worksheets, and the RIAA calculator. I'm going to be asking Brad to see if we can go over how this will change in EAP Connect more in depth during his training. For now, we're just going to go over the RIAA calculator, just because, I'll be honest, that's what I know best. The EAP income calculation and the sources of income. Okay, so crisis calculations are staying the same. For a regulated utility, each household is eligible to get up to $200 for each utility. Which means that if they are total electric, then both the electric portion and the heating portion of $200 each are eligible to go towards that one account for a total of $400. And if they heat with one of our unregulated utilities, propane, LP, fuel oil, wood pellets, biofuel, corn, or coal, then they are eligible for up to $200 crisis on that. For the calculation on them, with a regulated utility, you're always going to look at that utility bill and determine how much how much is the amount needed to prevent a disconnection. For the biofuels, bulk fuels, our unregulated utilities, for the purposes of our definition in the manual, the benefit is to be applied automatically to the utility at the time of initial application in order to ensure as large a delivery as possible. And once again, as last year, all crisis benefits are to be applied before applying the regular EAP benefits. So crisis application, the LSP must use crisis assistance in order to funds in order to alleviate crisis. So you must guarantee continuation of service. As long as continuation of service is guaranteed, the client can receive the crisis benefit. Client does not have to provide additional funds to cover the entire amount owed, as long as the utility company will continue service with a partial payment. So what that means in a nutshell is, say an applicant comes in and they have a disconnection amount of $300 on their gas bill. Obviously, if we give them the full $200 crisis benefit, if they're getting crisis benefit, they're going to qualify for regular benefit, which is going to be at least a couple $100. So that benefit will absolutely cover their entire disconnection amount. Say they come in with a disconnection amount of $600, and and if you give them the $200 crisis, and they only qualify for $250 of regular benefit, that's going to give them a total of $450, which is going to be $150 short of that disconnection amount. In that case, instead of just automatically denying the benefit, what you're going to want to do is contact the vendor and see if they will accept the $450 in order to suspend that disconnection. As long as the vendor agrees to continue service for a benefit, then you just document that and award that benefit, including that full crisis. If the vendor does not agree to continue service, that would be the case where you would need to get a $150 client contribution and document that. As Renee and I have been saying ad nauseum, documentation is key. If you don't document it, then in the eyes of any monitor or federal auditor, then it didn't happen. And of course, crisis benefits can be awarded to all fuel types. Bulk fuel clients still qualify for an upfront crisis benefit, and self-declaration of primary fuel level will be required for wood clients. So this was an example that was put in for last year. Again, I'm just using the slides from last year, so some of these might be difficult to use. This was basically an exercise I believe we used last year to determine what would be used in order to determine how much crisis. So in this case, the total bill is for $658.52. However, if you look in the important information underneath that total amount, it says your service is subject to disconnection anytime for non-payment of your previous past due balance of $346.14. And so when you're calculating crisis, that's going to be the number you're looking at. So again, if someone is eligible for $200, since this is, I believe, this is a combined electric and heating bill. We would be looking at, since it's combined, they would be eligible for up to $400. So in this case, what they would be eligible to actually get is $346.14. Remember that you are going up to the exact amount needed to mitigate the crisis. You should not be rounding up at all. And this would leave them with a balance of $53.86 in their crisis that they can come back for if they find themselves in disconnect before the end of the program year. This is the crisis benefit calculation worksheet that we do suggest or recommend that all LSPs make available to their intake and consider having them required. You don't have to require them, but it is considered a best practice. As you can see, there's some conditional formatting in there to show when something is being done that is required, when something is not being done that is required, or when or if someone is trying to give too much crisis, or if the amount of crisis being used is not going to mitigate the disconnection. And in those cases, if there's a red, again, it could be something where we're not able to actually cover the entire amount of the disconnection, but the utility will guarantee that continuation of service. So in that case, you might see the red, but that doesn't necessarily mean that's wrong. It just means that you need to take a look at it and maybe document why it's still okay. It's more to pull your attention to something that's a potential problem than an automatic disqualifier. And here is another example one that we used. So in this case, it is a $557 electric bill, and the disconnection amount is actually off to the left in this one, and it states that the account is past due and a payment of $455.80 is due immediately to avoid disconnection services. So obviously we could cover 200 of that with crisis, and because it's electric, unless it's a total electric household, they'd only be eligible for $125 regular. So we'd be looking at a total of $325 that we could pledge. So we would just have to, in this case, this is a January bill, if you look at the top. So this would be within moratorium. And so just verifying that they submitted an application and that they do qualify should be enough to stop that disconnection. And we would want to give that full $200 crisis along with $125 regular. And that is exactly what this shows. Income calculation spreadsheets. Again, we don't require you to require them of your intake, but they are recommended as a best practice. Some of your colleagues out in the network have collaborated to help create them and to help keep them updated and kind of innovate them as the years have gone by. They've really become quite a powerful tool. And from our perspective, they help to eliminate mathematical errors. They provide a clear picture of how the income is calculated. They're easy to double check in order to verify that the income has been entered correctly. They help with Renee's monitoring to show how the calculations were arrived at, and they help reduce errors in how crisis is calculated. So here is an example of what the income calculator looks like in RIAA. Again, this is going to be different in EAP Connect, which we are going to be transitioning to. But this just shows how within our database, if you have a recurring payment, it's easy to enter that recurring payment and the recurrence on it, and actually have the system calculate your total 3-month income for you rather than calculating it by hand. IFCDA does advocate for and recommend kind of removing that human error element wherever you can. Wherever you can have the work done for you, whether it's through one of the worksheets or the calculator within the database, please try to implement that as much as possible. Here is the rundown of the sources of income that we count. We count wages, salaries, tips, bonuses, commissions, self-employment, profits from business, military allotments, except for combat zone pay, disability payments from insurance, Social Security, SSI, railroad retirement and railroad disability benefits, Black Lung survivor benefits, income from rental property, life insurance payments, dividends, interest, gambling winnings, awards, pensions, annuities, retirement plans, royalties, strike benefits, unemployment benefits, veteran benefits, regular life insurance payments, workers' compensation, and alimony payments. If a client rather, or an applicant, to be more precise, turns in a bank statement as proof of their payments, you want to look for that PPD ID. The PPD ID is an indication that payment is actually a recurring payment. So that really makes it easy to identify what you might be missing. In this example, this person has 3 recurring payments. They have a pension. They receive Social Security, and they also have a public employment pension. So they have two different pensions there. One from bakery and confections, it looks like, and another one is an Indiana public employment pension. Income timelines, of course, as with last year, only 3 consecutive months of income is to be used for calculations. And also, you must use the most recent 3 months. A couple years ago, we did have language that you can use any consecutive 3-month period within the most recent 5-month period, and that language went away because it was kind of confusing and misleading. And the whole reason it was there was because we were using, we had the option of using the wage inquiries from the Department of Workforce Disability, and those really became untenable following some changes within DWD and the way those were processed. So we want you to use the most recent 3 months. Now you can choose whether that 3-month period that you're using is inclusive of the current month, or whether you want to look at the most recent 3 complete months. So for instance, let's say you are receiving an application in January 15th. If you're doing it inclusive of the current month, then you would count November, December, and January. If you're doing the most recent 3 complete months, you would use October, November, December. You are perfectly fine to decide how your LSP is going to navigate that issue. You can choose to do one or the other. What we ask is that whatever you choose, you stick with it, you document it in your policies or your internal controls, and that you apply it consistently to all applications. And also, as with last year, calculations should always be based on the documentation sent. If there's been a long lapse of time between when the mail-in was received and when it was processed, use the documentation that was sent in with the application, because you are going to be determining eligibility based on the application received date, not on the application entered date. You should not ask for additional documentation unless they just didn't turn in the documentation that you asked for or that you needed. But again, you always want to calculate based on that that application receipt date. So if they didn't send in pay stubs for one of their household members, when you request that information, you really should try to see if they can supply the pay stubs for that particular time period. And just here's some examples of pay stubs. So you always want to confirm up in the upper right-hand corner, you see advice date. And that is when we were looking at income and when the income was received, we are always looking at the advice date or the pay date. So you see that this pay period, if you look to the field over to the left of that first highlighting, kind of the center field in the top, the pay period here is July 10th through July 23rd. However, this pay was received on August 4th. And so August 4th is, we're going to consider this August pay. So if it's a matter of you're looking at August, September, October as your dates, and this one would count, even though the pay was for hours worked in July, because the pay itself was actually received in August. You always want to be sure that the documentation lists the employee name, so that you're sure that you are connecting the correct income with the correct person. And if you look down towards the bottom, you'll see some additional highlighting. This is an example of a pay stub, and we love it when we see pay stubs that accurately break this out. So this gives you both the total gross and the federal taxable gross. Whenever you have the federal taxable gross available to you, you always need to use that. However, by that same token, if a pay stub only has total gross, you're not allowed to manually calculate what that federal taxable gross would be. It's one of those unfortunate situations where sometimes it's just a matter of the payroll company that the employer uses. Some payroll companies do list the federal taxable gross on the pay stubs, some don't. And it's unfortunate. However, just as payroll companies differ in that, some payroll companies differ in abbreviations they use or in how they enumerate what deductions are pre-tax, what deductions are after tax. It just becomes really complicated and can lend itself to some misinterpretation of the data there or to income calculations. And so that's why we ask people not to calculate that federal taxable if it's not explicitly provided. And here's the example showing that data entered into one of our income calculation worksheets. And so in this case, that federal taxable gross of $25,539.47, it is going to be for the month of August, so 8 months, because August 4th was the pay date, and we're extracting 3 months of that, so that's going to be $9,577.30. W-2s can be used between January 1st and April 15th. I know that this past year, the tax season was extended all the way out, I think, until July. But because we want to keep it recent, we did not extend the use of W-2s. And so if something similar happens this year, I expect that we would use that as precedent and still keep to W-2s are only good until April 15th. But when you use W-2s, as you can see, box 1 gives you very clearly the wages, tips, and other compensation, and that is the number that you are going to use. The advantage of W-2s is that it's very simple. The disadvantage is that once you get out to April 15th, you're looking at the total income for the entire past year, and you don't know if that person's pay, salary information, and employment is still the same. So while it does streamline things, it can be somewhat problematic, especially if it's someone whose employment has changed, or if their hours have been cut since the previous year. And here is an example of entering the W-2 information into the worksheet. Calculating income for multiple jobs. When it's multiple jobs, you always want to be cognizant of whether jobs might have started after the first of the year, or rather after the 3-month period that the beginning of the 3-month period that you're considering, or whether they might have ended before the end of the 3-month period you're considering. So you always want to kind of look at that and ask questions. So in this example, you have an application date of April 30th, and you have 2 jobs. Job A was worked all year and had a pay date of April 28th. So in that case, it's a very simple case of taking the year to date, dividing by 4, since you're looking at April pay, and then multiplying by 3 to get your 3 months. However, job B started on February 22nd. So in that case, no matter how your agency operates, whether you look at the most recent 3 complete months or the 3-month period inclusive of the current month. In the former, you'll be looking at January, February, March, and in the latter, you'll be looking at February, March, and April. Either way, February is within that time period. So your pay stub here, your year to date on that most recent pay stub, is going to be from February 22nd through April 28th or April 30th, whatever the pay date is on job B. And so that entire job was actually within the 3-month period. So you are not going to divide by 4 because that pay stub does not represent 4 months worth of pay. It does only represent 3 months of pay, and so you are just going to take that year to date and just use it in its entirety. And so the gross income would be the 3-month prorated amount, quarterly amount for job A, plus the entire year to date of job B. And here's an example of just looking at pay stubs for multiple jobs, and entering it into the income calculation worksheet. As with last year, and as I said earlier, we are no longer using the wage inquiry from DWD. We only need it when a proof of unemployment is needed for income. Here is an example of our income verification affidavit. This form did change last year, but it has not changed this year. So just to real quickly go down, the applicant should fill out either Section 1 and or Section 2, whatever is applicable to them. Section 1 is for months in which they received some income, but they don't have documentation of that. So this may be, this is usually when they're working kind of odd jobs. So in this example, Andy applicant has been mowing lawns, and so he did receive $80 a month during July and August, and $60 during the month of September. However, that work dried up, and during the month of October, he received 0 income. So he rechecked off that month in Section 2 for having received 0. Now, whenever anyone checks off anything in Section 2 indicating that they did not receive 0 income during any of the 3-month period prior to application, they must fill out Section 3. If they do not do that during the initial application, and you go to process it and you see that they had a month where they had 0 income and they didn't 3, you do need to have them document that. And so you may have to have them fill this out again. We need some sort of meaningful statement showing what they received, especially if it is paid directly to them. And the reason for that is any household assistance that is paid directly to them rather than directly to the vendor, utility, retailer, whatever it is that's going to, is actually counted as income. So in this case, Andy applicant's parents gave him $200 a month for help with his rent. However, they paid it directly to him rather than directly to his landlord. So in that case, in addition to the 80, 80, and 60, you're also going to want to count $200 per month for the 3-month period because he was receiving that that directly to him. However, as you can see, his utility bill, his parents also helped him with, but that was paid directly to utility. It's okay that he didn't put in a dollar amount because since that was paid directly to utility, he's not necessarily going to know how much exactly it was. And since it was paid to the utility, we aren't going to worry about counting it as income. Same thing with the household expenses that the parents helped him out with and paid directly to the store retailer. That's not going to count as income. We don't necessarily need to know exactly how much it was. Now, if they had just given him money and told him to buy to buy whatever supplies he needed for his household, then we would need to know how much, at least an estimate, and we would need to count that as income. And for food, as you can see, he just filled in that he went to the food bank and received SNAP. In that case, those are benefits that we don't count as income, so we're not going to be concerned with how much he received. Okay, so unemployment benefit calculation. This is not necessarily how it currently looks. The state system kind of keeps changing how it looks. I think the important thing is that you notice that there is a discrepancy between the entitlement and the net. The entitlement is how much the person is authorized to receive. However, the net is how much they actually receive. And you notice that the gross is actually lower than the net. This is because any holdings that are taken out of the unemployment payment for whatever reason are actually so in the world of unemployment, the terminology is kind of backwards from what they are with wages. The net is the total amount that the person quote unquote receives from the system, but the gross is how much they actually realize from that after any taxes and other withholdings are taken in. So what we're going to do when it comes to unemployment, it's a little bit, it is a little bit, I'm sorry, I'm blanking on my words, unintuitive or counterintuitive, but you are going to take the net rather than the gross. Alternatively, you could take the gross and the total withholdings, which will add up to that net. But the best practice is to just take that net because that involves less addition. The other thing you also want to look at is the process date as opposed to the week ending, because the process date is going to be when they actually received that money. So you notice, for instance, if you look all the way on the right at the bottom, that very first one there, the benefit for the week ending September 23rd was not paid out until October 8th. In fact, on October 8th, this person received their payments for the weeks ending September 23rd, September 30th, and October 7th. They received 3 weeks worth of unemployment benefits during that one day. And they actually didn't pay out at that time because, as you can see, the net is 0. It takes a lot of practice to get used to reading these statements. And if anyone has any trouble with them, we do encourage you to reach out to IHCDA or to your peers within the network for guidance or advice on them. And here is an example of that previous statement being entered into a worksheet. Self-employment. So self-employment, we had some changes last year. And I'll be honest, last year, the training that we provided kind of backfired on us because they changed the forms again. I am going to wait until I see new forms from the IRS, and then I'm going to be issuing additional guidance at that time. But just some general guidance on self-employment. So people who are self-employed can use a 1040 any time of the year, not just during January, February, March, or April. It must be for the most recent complete calendar year. So for instance, if they are applying in January of 2021, let's go even later. Let's say they're applying in March of 2020. They are not required to have completed their 2020 taxes until April 15th. So if they're applying in March of 2021, they may not have completed their 2020 taxes, and so they can apply using their 2019 taxes. Now, if they have already filed their 2020 taxes, then they must use the 2020 taxes. It's whatever they filed most recently. They must also provide all the appropriate schedules to complete self-employment verification. That would generally include Schedule 1 and then either C, E, F, or SE, along with that 1040. And we're going to use the gross income to calculate the income. We must also look at utilities box on Schedule C, which may or may not still be box 25 on Schedule C, or box 17 on Schedule E, and also line 30 on Schedule F. Again, I will give out more specific guidance once I see the new forms. If the person has a home business, they may have taken this utility deduction, and the deduction should be added back into the income so that the person is not getting two federal benefits on the same utility. And we are going to use the gross income. If that gross income is 0 or if it's a negative amount, then the client is not required to provide a wage inquiry from the DWD. So here is an example based on the 2018 taxes. So Schedule 1 provides a summary of all of the person's self-employment income. Schedule 1 by itself does not give you what you need, but what it does is it tells you through the information that's on it what other schedules should be present. So Schedule C is going to be where you get your business income or loss. As of the 2018 form, we were using gross income line 7, while also paying attention to the business address. And if the business address matches the home address and the utility deduction is taken, then we would have to add the amount of that deduction back into the total household income. Schedule E was a supplemental income and loss. That would be where rents and royalties would be documented using lines 3 and 4, as well as any utility deductions associated with those. And then Schedule F is the profit or loss from farming. As of 2018, we were using line 9 for the gross income, and we were looking at line 30 for any utility deduction that may have been taken. Schedule SE is a self-employment tax long form schedule, and we only use this in very specific cases where they had a church employee income. Because of the nature of the Schedule SE, there were no utility deductions available to be taken, so we didn't need to worry about looking for that. And here's an example of entering self-employment data onto one of the worksheets. If we have self-employment and the spouse has a job, we want to be sure to consider both of those as sources of household income. And this is why we're not just using the AGI for the household. Well, it's one reason why we're not just using the AGI for the household. But we really do need to capture the income for both, or for all adults rather, within the household. And here is that scenario that was on this previous page being put into an income calculation worksheet. When you're calculating Social Security, the best way to get that is from an award letter. An award letter can be downloaded from a person's My Social Security, I think it's myssa.gov account. If someone does not have a recent Social Security award letter, if your intake staff has the capacity, you should always try to help that applicant to set up that account and to download that letter, just because it really is the easiest way to do it. In this case, as you can see, this person just received $661 per month. We put it into the worksheet, multiply by 3, and it just spits out that number. It's really easy. Now, as you see, this letter starts out with a monthly amount before deductions, and then it goes through a series of deductions. With any Social Security Administration administered benefit, you always want to take the amount actually received. So this is one instance where you're actually taking the actual net and not the gross. And so that bottom line, which in this case, this person has no deductions, so the bottom line is equal to the top line. But if they did have deductions, that bottom line would actually be lower, and that would be the number that that this intake staff would use. And then, of course, if someone is applying during a time when they are receiving an increase, a COLA, cost of living adjustment to their Social Security, if that is explicitly stated on the letter, and if it is taking place during that 3-month period that you're looking at, then it is the responsibility of the intake to make sure that they are accounting for that increase. And this letter just goes through how to do that. So in this case, it does show that the person applied on February 15th. The award letter stated that they received $735 until January 1st, and then it was going up to $750. So in this case, the intake took 2 months of $735, so account for November, December, and then also added in $750, so account for January, to get that total 3 month of income. And of course, because we're looking at November, December, January, that means that this this particular LSP was looking at 3 months, three complete months, rather than inclusive of the current month. So this again was a very quick and dirty overview, high-level overview of the income calculations. We'll be very happy to take questions to explain things more if the consensus is that you want more explanation or need more explanation on anything that we've already gone over. I will be putting out policy guidance and possibly another video when I receive clarification on what's going to be happening with self-employment. Just remember, all household income calculations must be shown in the file, including any manual calculations, adding tape spreadsheet. We do encourage people to use the spreadsheet or to use the onboard calculator within the database as opposed to manual calculations or adding tape. Wherever you can reduce that element of human error, that's going to be preferable. And whenever the date may be different, notes as to why should need to be entered into the statewide database. That brings me to the end of this presentation. got in about 45 minutes this time, so getting better. Hope this was helpful to everyone. And we will, again, be happy to take any questions and provide any support and guidance that everyone needs. Thank you, everyone.